Exciting.
Yeah.
So, Mosh, why should one invest?
Look, the key thing with investing is that the issue is inflation, and people don't understand inflation. Inflation in the UK is 11%. So let's say you got 10 grand, you left it in your bank account, okay? They might have given you 1% interest, okay? 100 quid you made, and you might be buzzing, oh, I've made £100. But really, if inflation is 11%, you've actually lost 10% of your money. So the value of the money goes down.
Okay. Well, one thing I always thought about is when one starts investing, like it seems so complicated these days. You've got online stuff, you've got ISA bond accounts, you've got stocks. Like, where does one start if they want to even try and start investing?
Look, there is different ways, and depends on your age. So, for example, someone really old, let's say you're getting close to retirement, you're 50 plus, okay? For those types of people, they want something very secure and safe, because the stock market goes up and down, it fluctuates, and it goes in cycles. And, like recently we've had a crash, it's coming back up again. During the pandemic, there's a massive crash, and then it shot straight back up. That's where I made a shitload of money.
Yeah.
Honestly, but even anyone, if you invested in anything, you would have probably 10x your money. That's how easy it was back then.
No, bro, don't remember getting a call from you to let me know about it.
Bro, of course I don't think I knew you then, did I?
Bro, that's not an excuse.
What do you think that's an excuse? So, look, if you're young, stock market, because on average, the stock market, whether you take, it's been through 2 world wars, recessions, oil embargo, so many things. The last 100 years, the average is about 11-12% in the stock market. For the last 10 years, it's even higher.
Really?
So in a long enough time frame, you're always going to make money in the stock market. Because look, what is the stock market? It's businesses, isn't it? Apple, your Microsoft, these sorts of companies, they make up most of the stock market value itself. So you're investing in those companies. And if those companies are making profit, then you're making money as well in the share price going up.
Just on the stock market, one thing I've always been unsure of is, how do you know what's a good investment?
Well, that's
what factors and parameters do you bear in mind when you go, right, I want to pick this stock to invest in?
Okay. First thing is your own experience as a consumer. So, for example, you've got an Apple phone, yeah? If you think it's a good quality product, the services are really good, and you think it's great, obviously that's an indicator they've got a great product. They've got great software. Everything else they do, overcharging people, I personally think, but they make a lot of money.
Yeah.
In the stock market, iPhones are considered a luxury good.
Oh, right, okay.
Because the price is so high above the normal price for like a normal phone.
Yeah, I see, I suppose. Yeah. Okay.
So that's the first thing. As a consumer, you know what works, what doesn't. If you see like an up and coming company about, and you think, actually, they're going to do really well, you can invest in that company if it's public. Okay. Second thing is looking at the financials. So you can look at a company's balance sheet, see if they're making profit. You can do that work yourself. Third thing, which I think is the easiest way for a beginner, is the S&P 500. You invest in a stock index fund. So index funds is hundreds of thousands of stocks that they combine together. And for example, if you invest in the S&P 500 index fund, you invest in the top 500 companies in the US. So you don't have to worry about looking at the balance sheet, X, Y, Z. You just invest, forget about it, and get the returns.
Okay, but here's the thing. Do you not have to have a decent amount of capital to put in the stock market to have any returns? Or, what I mean is it worth you putting in a few hundred if someone's got that spare? Or is it not worth doing that, because you should really be putting in the thousands? Because the more you put in, the more you get, more benefit you get out of it.
Yes, but it depends. Again, it depends on the type of investor you are. So let me show you something.
Because it's always been my impression that if you're going for something like the stock market and you're putting money in, unless you've got a significant amount, you're not really going to see much on your returns. So the question is it worth it? Do you put your money into that, or do you put your money into something else which you're going to see, let's say, quicker returns on?
All right,
Isn't it? Don't they consider it as a long game?
There's no such thing as quick money unless you're in trading and you're trading with over 100k. There's no such thing as quick money. 2020 was really easy because everyone was making money. It went mental. Okay, you could have become a millionaire in 10k.
I was paying off credit cards.
So, for example, if you invested $1,000 in Tesla in 2011, now it'd be worth $204,000.
Wow,
that's £1,000. So imagine you put £10,000 and you'd be a millionaire.
Yeah, but here's the thing: the reason why these kind of things annoy me is that the reason I'm speaking to you about this is, how would myself as a beginner know or predict within a decent having a decent prediction? How could one predict that Tesla would be doing significantly?
Okay,
because clearly there'll be some like that today, some companies.
Yeah.
That someone's going to be sitting around in 10 years to say, oh, in 2023, if you'd invested in so and so, it'd be worth this much. How is one supposed to know? How are we supposed to know today and make a good prediction on it? What do we have to know about? What do we have to research to know this has some potential to do well in about 10 years?
I would say this is where your level of foresight comes in. Okay, so as I said, people that invest in Tesla back in the days, they knew about Elon Musk, they knew about the product they're trying to bring to market, you know, the first proper commercialized electric car.
Mm-hmm.
So, you know, they jumped on that bandwagon. It's a bit like Bitcoin. The early investors in Bitcoin when it was under $1, you know, you're buying it off like $0.1 each Bitcoin, they believed in the idea. So I think the first thing is the belief. If you strongly believe in a company or its product, I would say always invest. Even if it's a little bit of money, always invest. I'll give you my personal example. There's a car company called NIO. It's a Chinese electric car company maker. Mm-hmm. Now, I started buying it at $4 per share. It got to, I think, around $52 at its peak.
Whoa.
Exactly.
That's significant.
And I made a decent buck on that.
Bloody hell, not bad.
So you're not going to find them all the time. Okay. Yeah. But by the way, now it's crashed back down. Now it's crashed back down to about $10.
Right. Okay.
So even then, if I invested $4, I still doubled my money. But I sold out quite a while back. So you either find companies that are undervalued. You either find companies that are up and coming that have a good product or service that you know is going to do really well. Mm-hmm. Or what you do, the safest way I would say, if you don't want to go through that route, you just invest in an index fund. S&P 500, you can invest in all companies around the world if you want. There's an Islamic ETF as well. So just invest in, you know, like they don't invest in companies that you sell alcohol, gambling, that sort of stuff.
Right.
Okay, so it covers that aspect as well. You can invest in the BRICS company, and I'll show you. I invested in BRICS recently. And this was Invest Engine. So Invest Engine, what they do is, it's like a robo trader. So they have investors on the other side. They do all the investing for you. They do all the rebalancing. And the fee is really low. It's like 0.25%.
So say that again, what's that?
So it's called Invest Engine, and I've done a couple of videos about it anyway. And I think if you open an account, invest over £100, they give you £25. Right. If you invest over £100 and leave that in for a year.
So someone invests on your behalf?
Yeah, so you give it to professionals to invest.
Right.
And their benefit is they'll charge you a small fee. Okay. So, for example, can you see here? So I invested in Invesco FTSE 100. It's the top 100 companies in the UK. That's up 3.76%.
Yeah.
The iShares BRIC, it was up higher. It's gone down, but it's going back up again, 0.33%. I invest in iShares Physical Gold. So it's an ETF that just buys gold and stores it. So that's up 1.54%. And you can see the others are slightly up as well. Even the World Islamic by iShares is up 0.79%. And you get dividends off it as well.
I see. Okay, I guess the other thing, it's all good when people invest and put money in. But a question I've always thought is, and I never quite known the answer to is, and you're probably going to laugh because it's such a common thing, is when do you know the right time to pull out? When you've got funds in there, because you always hear about people going, oh, if I just pulled out at this so-and-so, but now it's crashed, or I got it out at the right time. So, okay, take a step back. How do you know? What do you use to work out and calculate and make your decision on now's the right time to pull out?
Bro, you never pull out.
Sorry. Explain.
Sorry.
Explain for the viewers.
Sorry. So basically, if your plan is to retire early, as I said, there's no such as quick money or quick gains unless you do trading. Again, I've done trading as well myself, and you can make I've made thousands in a day. I've lost £5,000 overnight doing trading. So trading is you got to know what you're doing,
right?
But investing is a long-term game.
Okay.
So the earlier you start, the better it is. So for example, if you think about yourself and you want to retire at 55, okay, well UK is going to 58 now, early retirement. So you want to retire at 58. You want to have a comfortable life. You know, if you got 58, we've all worked it out. It's not much. You lose a massive chunk of your pension.
68.
Well, the normal retirement age is 60, isn't it?
But the earliest you can retire.
Earliest now is 57 or 58. They change it to.
Yeah, okay.
So if you got 57 or 58, you lose a massive chunk of your pension. It's basically unlivable salary. So you got to have something else as an investment.
Yeah.
And for me, you either go into property in the UK. Property is probably one of the best investments, but obviously you need a lot of capital to go into that.
Yeah.
Or stocks and shares. Stocks and shares is nice and easy. You can put in a certain amount every month. You can use Trading 212. It's completely free, and you can use that. And obviously, when you sign up, you get a share worth up to £100 as well. I'll send you the link, and I'll put it in the box below for the viewers as well.
Oh, I see. Nice. So you're saying about investing, you keep your money in. What about a company that you see that's hit rock bottom and it doesn't look like there's any recovery from it? Do you still keep your money in there? At what point do you make a decision of leave the money in, or actually no, cut my losses and take the money out?
Look, you know what you're describing? You're describing an active investor. If you want to make quick gains, which you can, if you get experience enough, you can make easily 5% a day, I reckon. So imagine you compound 5% every day of like £1,000. You'll make shit ton of money at the end of the year. So that's an active investor. So that you got to do technical analysis. So for example, I'll show you a quick graph. So let's put in NIO recently, and I bought some shares in it when it was around $7-8, and now it's up to 10. So this is basically what we call technical analysis. So you can base some techniques, like, can you see it moves in waves? Can you see it goes down, then goes back up, goes down, back up, goes down, back up?
Yeah.
So I identified when it was around $7, it's at its bottom of its peak. So if I was a short-term trader, what I could do is this. I could have bought around $7 and sold near the top, and that's a 34% gain. So imagine you put 10 grand in that and you're playing with that.
Yeah.
You would have made 34% gain, and it's on leverage. You would have made 3x that as well, or 5x.
What do you mean by leverage?
Leverage is where basically you borrow the traders or the brokers' money. So Trading 212 do it. It's called CFDs, and it's on leverage. So for example, if the price went up 30% and there's a 3x leverage, it'll go up 90%.
Right.
So if you put 10 grand in, you'd pretty much be close to getting 20 grand back.
Oh, okay. All right.
But leverage obviously goes the other way down. So a leverage, if it goes down 10%, or if it goes down 30%, and you've got 3x leverage, you're down 90%. So you wiped out your whole account pretty much. So that's the risk. But there's certain things you can do about risk management, like stop losses and things like that. But it's a skill that you got to learn. And bro, it's easy. Look, you look at this graph over, this is from 2021, and it's a weekly graph. If I do daily, look how it moves. So it always moves in waves.
Yeah, ebbs and flows.
Yeah. And if you can catch that ebb and flow and you get skilled at doing that, then you make a shit ton of money. But that's called being a trader.
But that means you've got to actively do it. So for let's
it's
say
like a full time. I mean, you can do it part time. You just got to keep an eye on things.
okay, but for the average person who's got a full-time job, who's not an active trader, hasn't got the time for it, for trading, then what would you recommend the best way to go about trading? But something that you can do passive without having to actively be on the computer all the time working on all this stuff.
I mean, trading you can't do passively. Investing you can do passively. So investing is basically you put in £100 a month or £500 a month into an index fund, and it's very low fee. It's like always less than 1%. It's like 0.25% or less than that. Okay, especially if you go with someone like Vanguard, they're the top dogs basically. And you just put in money. Then over the long term, sometimes it may go down, sometimes it may go up, but you just leave it because you're looking at a long-term game. You're looking at the 15, 20 year cycle or your retirement goals.
Okay. Well, I guess, there's different ways you can go about it. So if I was to ask you this then, if you had £1,000, if you had £50,000 and you had £500,000, where would you invest that money?
If I had £500,000, I'd put it into a index fund and get dividends. Dividends, you'll get around 3%. So the profit the companies make, obviously you get a portion of that profit. So if we do 500,000 and 3% of that, you're making 15 grand a year.
So
just off the dividends.
So what do you mean then, an index fund?
So index fund is it's like a basket of companies. So for example, the Vanguard S&P 500, what they'll do is, like your American companies, Tesla, GM, Ford, Apple, Microsoft, all the top 500 companies in the US, they'll put into one basket.
Right.
So you're investing into that basket.
Okay.
Okay. So I'll show you an example of Vanguard. So can you see here they've got 503 stocks, and it's really low fees, 0.07%, which is barely anything. That's the fees they take to run it, and the reason why it's so low because they're managing trillions of dollars. Like pension funds and stuff like that.
All right.
Everyone's invested in this.
Right. Okay.
And if we look at the companies, so they've got 500 companies and they do it by percentage. So of Vanguard, 7.48% is made up by Apple because it's one of the biggest US companies. Then Microsoft, Amazon, Nvidia, Alphabet, which is Google, Facebook, Berkshire Hathaway, Tesla, United Health. So based on how much market share they have. Right. So you're basically investing in 503 companies.
Shit, okay. And your return on your investment is that?
On average, I've worked out over the last 100 years is about 11%. That's 2 world wars, depressions, recessions, financial crisis on average. So you have to look at it in long term. 1 year might be down, then the next year might be up 20%. But on average, what history and data tells us, you will always make your money back.
I guess the only thing is that you have to be willing to put away that much money and not touch it, not have any access to it.
You don't
for so long.
You don't have to even put out that much money. It's the long term game. So if you put £300 to £500 a month, you'd probably end up in $1 million after 20 or 30 years of investing.
Say that again. £200-300.
Okay, look, it's still compounding. This is what people.
So you're telling me if I give you £200-300 and I come back to you in 20 years, you'll have made me $1 million.
Maybe I think I worked out before. I think it's £500. £300 gets you under $1 million.
I'll give you £500, and if you
Look,
next paycheck, I'll give you £500, and I'll hold you to that. In 20 years,
all right, look,
I want my fucking $1 million in a check.
Okay, so let's put at the lower end is 11%. Okay, so let's do 25 years because that's generally the life of a mortgage, isn't it? That's how I do it. And let's start with £500 first. And your average is 11%. Okay, so just under $1 million. £500 in 25 years. Your investment after 25 years is $788,000. And that's at the conservative end of 11%, compounding every year.
Okay, so if I had £500 tomorrow, let's just say.
Yeah. But you got to do this over 25 years.
Okay, fine. So what would I do to park that money? Would I put it into?
So you can go to Vanguard website directly. You can even open up a Trading 212 account. It's probably the easiest. But what you want to do it, and this is another thing people understand, into an ISA. So an ISA is a tax-free in stocks and shares account. So any returns you make on that, there's no tax, zero tax. Any dividend that's paid in your ISA account, zero tax. And your limit, I think, is, I'll just double check for you. I think is 20,000.
So, okay.
Stocks and shares ISA allowance. Yeah, it's 20,000 a year. So you can invest up to 20,000 a year. Any gain, so let's say you invested 1,000 in your ISA, like for example in Tesla, it goes to £1 million. That £1 million is tax free. It's the only situation where the government is not going to come after you for your money. You know very well that we're taxed on everything.
Yeah.
VAT, income tax, national insurance, council tax, property tax. Anything you buy in this country, you're taxed. It's the only allowance they've given you that is not taxable in an ISA.
So you have to so within a trading account like Trading 212, so you can further open up an ISA.
Yeah, so you can open up an invest in ISA. And if you're doing long-term investing in the UK, I always recommend doing it in an ISA.
Okay, and if I put in £500 into that?
Okay, so then you'll have to go to the Vanguard ETF.
Okay.
So I'll bring it up for you.
So Vanguard ETF, put in 500 quid.
Yeah.
And then just keep an eye on it for 20, 25 years.
You don't even need to keep an eye on it. You just keep investing. So you go to the Vanguard S&P 500. Okay, one share is $83 at the moment, but obviously, actually, you don't want the American version. You want the UK version. So £65 for one share. So you can buy however many shares you want or a certain amount of shares, and you just keep buying that every month.
Okay, so really you can put, realistically, if the average person can put a couple of £100 aside a month.
Yeah, look, we can change this. So let's put it to £200. By the way, that £788,000 that you've made in 25 years, again, that's at the lower end of the S&P 500 returns.
Right. So
okay, this is your interest earned, or the amount that you made from that 11%. And the total of, just investing £500, total deposits you made is only £150,000. So from £150,000, you're getting at the end of 25 years $788,000.
Not bad, So that's £500 a month, though.
Yeah, that's £500 now. Obviously, if we go a little bit lower, if someone's obviously a bit tight for money, £200. So this is £200 at the lower end. So you can see again, £200 25 years, 315,000, and your total deposits would be 60,000 in the 25 years.
I guess it's not bad,
So and that's the conservative end of the stock market returns.
So if I was to put a couple of £100 away a month in 25 years, I could get quite a few £100,000.
Yeah. So basically, you have to be disciplined, though. This is where people fall down because it takes time. You're looking at 20, 30 years, almost your whole working life. And if you're disciplined, and this is why the rich people get richer, because they understand all this stuff. So you put that money in and you leave it, you put a certain amount in every single month, and you just watch it compound over time.